Good morning again, everyone. My name is Ryan Landy, an Assistant Vice President of Investment Management at SYGNUS Capital Limited, the investment manager for SYGNUS Credit Investments Limited. We will be having a Q&A session towards the end of the presentation. We encourage everyone to send in their questions during the presentation, and these questions will be addressed in the Q&A section of the presentation, earnings call presentation. The presentation will be available on the SYGNUS Group website, as well as the recording, which will be available on YouTube, as well as the SYGNUS Group's website. I now welcome Jason Morris, our Chief Investment Officer, to walk us through the presentation for financial year ended June 2023. Mr. Morris?
Thanks, Ryan. Morning, everyone. Hope everyone had a fantastic weekend. I know that all the Arsenal fans in the house, are still enjoying the sweet victory yesterday over Man United. So big up all the Gooners who are on the call. All right, let's jump right into it. Giving some little insights into the financial performance of SCI for the financial year ended June 2023. So let's move through to the next slide, Ryan. As usual, please note that we should read the audited financial statements, which are published both on the JC website as well as on SYGNUS Group's website, as well as the detailed management discussion and analysis that accompany the financial statements. There are two separate documents. You have the audited financials by itself, and you have the MD&A by itself. And I hope you go to read them in conjunction. So to present a quick backdrop, not everyone on the call may know what SYGNUS does, or so I'm just giving a little quick backdrop to what SYGNUS has done since inception in 2017, with the first financial year ended 2018 to now. So the first one I want to go through is that from the first financial year in 2018, when SCI would have been invested in only one territory, which was Jamaica at the time, 5 industries, and had 7 private credit investments. You fast forward to the end of the current financial year, SCI is now diversified across 8 territories, and that is after concluding the acquisition of Accent Financial Corporation in Puerto Rico, 22 industries, and 163 private credit investments. And the diversification, particularly on the industries and the number of private credit investments, would have been a direct result of the acquisition of Puerto Rico. Of course, all of what I'm going through on the backdrop includes the underlying portfolio of AFC, but please note that for the purpose of the audited financial statements, AFC is not consolidated. So what I'm doing here is just giving you basically additional color to show you what the actual overall credit portfolio, which the financial results effectively reflects that. Second thing I want to go through is the fact that the private credit portfolio, when you incorporate what is in Puerto Rico, has now would have moved from 15.7 million at the end of the first full financial year of SCI, and it's now at 197.2 million. So the math geniuses, can work out what kind of increase that is. So a substantial jump, in private credit portfolio overall for the group. Again, substantially benefited from AFC in Puerto Rico. Third point I want to show you is that in terms of when SCI started paying dividends, the first dividend would have been paid in October 2018, which would be, in the 2019 financial year. And for that financial year, the first year we started paying dividends, the dividend per share would have been $0.0030 US, right? And at the end of the last financial year, during the financial year would have paid 0.0043 US dollars. So that's, you know, we have been increasing the dividends. Of course, in total, dollar value would have paid 10.4 million US dollars in dividends over that, you know, 2019 financial year through to the end of 2023 financial year. And of course, as we go through the presentation, there will be a dividend consideration by SCI sometime in early September. First thing is in terms of deployment. So the private credit platform in 2018 financial year, SCI would have deployed 15.7 million across the 1 territory, the 5 industries, and 7 private credit investments. And if fast forward to the end of the current financial year, the financial year June 2023 that we are reviewing, combined, the deployment would have been 96.2 million US dollars. So that's almost 100 million US. With the majority of that coming from Puerto Rico being 65 million, as you learn as you go through the presentation. So again, what we are seeing here is that Puerto Rico is a very important key strategic thrust for SCI, and as we go through from, you know, this financial year to other future financial years, Puerto Rico is going to play a substantial role in the growth and trajectory of SCI. Of course, you know, in total, SCI would have deployed 335.8 million, and this includes the deployment from Accrescent Financial Corporation from March 1 of 2022. So that is one after the concluding of the acquisition. It's 335.8 million the platform would have deployed in total, with SCI excluding Puerto Rico accounting for 251 million of that. And in terms of, okay, we have deployed this amount of money, how much money have we actually lost? You know, last year we would have taken a charge off for Cayman hospitality asset. So the annualized loss rate, annualized charge off would be 23 basis points since SCI started operating. So we have only lost 0.23% crystallized loss of the 335 million that has been deployed across the group so far. 15th credit rating, we had promised to for SCI to be you know, run to international best practice, so we had to get a credit rating. And in September 2021, we had our first rating review. We were rated JM-BBB stable by Caracris, and fast forward to August 2023, our credit rating is now JM-BBB plus stable, and on the Caribbean scale, BBB minus with a stable outlook. And finally, you know, all of what has gone on before, the question is, what is the state of SCI's balance sheet? I mean, we would have gone through COVID, which would have been a 100-year event. And of course, you know, that's Ryan, you jump too fast. I'm not, go back to the slide. So the balance sheet, SCI has been operating with a net debt to equity. Well, at the end of the financial year 2023, net debt to equity 1.1 times, which tells you that in terms of leverage, the balance sheet is not really leverage. And when we started using leverage during 2020 financial year, which was during COVID, and the leverage at that time was 0.6 times. So 0.6 times to 1.1 times. If you compare that with traditional banks, etc., although we're not a bank, you're not talking about leverage of up to 10 times. So what this tells you that basically the business is built to withstand all type of economic environments, because we have a limit, a leverage limit of 2 times, and we haven't even come anywhere close to that since we started operating the business. And this discipline to ensure that we maintain a lowly leverage business in keeping with international benchmark for private credit businesses is what makes SCI, you know, positioned to do great things across the Caribbean region, and as we build out the additional legs for the business standard. And of course, asset coverage, which is kind of I wouldn't call it capital adequacy, but it's just basically a metric that is utilized by private credit companies to say how fast can we convert assets into cash to repay debt if the need were to arise. I need to maintain a minimum of 1.5 times based on international benchmarks. And of course, in 2020, which is when we started using debt. That ratio was 2.1 times. It's now at 1.8 times. So well ahead of what the benchmarks are. So now to get into the actual financial results for the year, after presenting that backdrop for everybody. For the year, Ryan, can you move to the next slide? So for the year, would have generated a net profits of 5.13 million, up 34.3%, versus 3.82 million in the previous financial year. And this would have been driven by a number of different things, as I explained to you in a couple of slides. One of them would have been the fact that we grew net interest income. Would have also increased our non-interest income revenue, which primarily fee income, which would have spoken about on a number of different earnings calls, saying that we want to buttress the diversification of the revenue streams by doing additional activity that will bring in fee income, and we want to really push this to get towards the $1 to $2 million threshold on an annual basis. We're far ways away from that at the moment, but that would have also contributed. And of course, in the previous financial year, would have had a large charge of the Cayman asset, which we didn't have that huge charge of this year. And so combination of those things resulted in the record net profit. In terms of on the revenue side, total, we had record total investment income 8.89 million. Would have been driven again, as I would have explained earlier, by net interest income growing by $1 million. Would have also benefited from FX gains. Of course, SCI is a 96% of its assets are thereabouts are denominated in US dollars. And so we have about 4% in J dollar assets, which obviously also means that we have J dollar liabilities. And on a net basis, SCI's net on our liability side, we are short Jamaican dollars. And so if the currency moves, depreciate, then we benefit from that. So we also had some FX gain versus last year when I think we registered 450,000 in FX losses. Net investment income. So this is when you incorporate operating expenses. It fell a little bit by 3.5% to 5.08 million, and that would have been due to a combination of two things. One of them is that the pace of revenues from the Puerto Rico business was a bit lower than last year, and that had to do partly with a number of tax adjustments that would have taken place in June. As you might have known, we also would have closed out the integration of the Puerto Rico business effective June 30th / July 1st. And so there would have been a number of items that would have been adjustment that would have been made primarily through tax that would have impacted the net benefit from the Puerto Rico business in the month of June relative to what would have done last year. So if it weren't for that, we would have beaten the previous record for net investment income. But that it is what it is. In terms of earnings per share, this would have been 0.87 US cents versus 0.65 US cents last year, for all the reasons that I would have explained earlier. And dividends per share, that is dividends paid during the financial year, would have been 0.00431 versus 0.00524 last financial year. And in terms of dollar value, the total dividends paid for the financial year during the financial year would have been 2.55 million versus 3.1 million paid during the previous financial year. Of course, you have to note that the first dividend paid during the financial year is really based on the results of the previous financial year, right? And of course, the results of the previous financial year would have been 3.8 million. So the first dividend paid in this financial year would be a little bit down. Similarly, because we are now reporting on the financial results for 2023 financial year, then it's likely that a dividend that will be considered by SCI based on these financial results, obviously reflect the fact that the financial results were better than last year. So we are just showing the dividend paid during the financial year, which obviously does not reflect the financial result of the financial year, because the first dividend paid during the financial year is paid on the previous year's financial results. Moving to the next slide. This just shows you, the historical core revenues and core earnings, which is total investment income versus net investment income. And as you can see, SCI doesn't have a problem growing the business. We just have to ensure that we do so in a prudent manner. Now on slide 6, I want to highlight a few items. I would have gone through most of these, so I'm not going to read through the summary financial statements. Of course, the summary financial statements look a little bit different from what the actual audited financial statement is. And of course, we present it this way to show you how the business actually operates and show you what is core to our business versus what is not non-core, just for those who are participating for the first time. So the first thing I want to highlight, which I've been doing now for maybe 5 quarters since we acquired Accent Financial Corporation, is the fact that there's a gapping effect in terms of interest income and interest expense, because on the interest income side, because Accent is not consolidated, we're not receiving any interest income there. But on the interest expense side, we are paying the interest expense for the capital that we use to finance the acquisition of Accent. So in other words, we use debt, which means that our debt went up, and we are paying interest expense on that debt, which flows through SCI's income statement, but we don't have any interest income coming from Accent because it's not consolidated. So the way we make up for that is through the line item called Puerto Rico Credit Fund Investment Income, which shows effectively, for want of a better term, the net change in the book value of Accent Financial Corporation, which includes a number of different things such as controlled premiums and marketability discounts and price to book of similarly publicly listed entities in the US, right? But without going into all of that complexity, effectively, interest expense is always gonna be higher than it would otherwise be, and so net interest income is gonna be a bit lower than it would otherwise be because we don't have any consolidation running through on the interest income side. And of course, we break this out for you by showing you the Puerto Rico Credit Fund Investment Income income, so to speak, which on the face of the actual audited financial statements, you don't see this figure because this figure is part of overall fair value gain that SCI generates. So there are 2 items that give you overall fair value gain, which will be fair value gain or loss that you see of 886,491, and of course the Puerto Rico Credit Fund Investment Income. And there might be some little minor adjustments that you'll see on the face of the audited financial statements. So I'm breaking it out for you so that if you're trying to compare this with the audited financial statements, you're wondering how we got back all of the numbers. That's how the breakout is. So this is showing you the actual core revenue of the business. One other item, when I highlighted the participation and commitment fees, I was saying earlier that this is an enhancement to the overall total investment income, which we're saying that we are going to do a number of different things to ensure that we're generating a lot more fee income. And as we go through time, we really want this to be in the $1 to $2 million range. And I'll have more on that as we go through additional earnings call in the future. So Ryan, you can move on to the next slide. So efficiency and management expense, as far as the efficiency ratio goes, which that's captured by looking at total operating expense as a percentage of total investment income, would have gone above the 40% benchmark threshold by a little bit. Majority of this had to do with a number of one-hour professional fees, as well as about 119,000 in performance fee, simply because of the fact that the net profit would have been a record, which would have beaten the hurdle rate of 6% that SCI has. So effectively, we would have paid some upfront fees, majority of which would have been in relation to an item that we have been discussing for a number of quarters now, which is access to international financing credit facilities. We are still in discussions with our international partners, but to activate that process, we have to pay some upfront fees. And of course, those upfront fees would have been large relative to overall operating expenses. But of course, you know, this won't be large once if we are successful in getting that, the 100 million overall that we are seeking from multiple parties. So that's what really drove the performance in terms of generating an efficiency ratio above 40%. Of course, you look at many financial firms, they have efficiency ratios in the 60s and 70s. So we are really saying that efficiency ratio is important for us to monitor, because we are trying to ensure that there isn't any wastage in terms of generating the revenue and then it goes back out in expenses, right? And then the other way to look at the business is the management expense ratio, which is you take the same operating expense and you divide it by your total assets under management, and our threshold is 2.85%. We need to stay below that, and we were at 2.3%, and we expect to remain substantially below that for the foreseeable future. As far as the balance sheet goes, quick summary. On the asset side of the balance sheet, shareholders' equity, almost 70 million US, up 3.5%, and total assets, 163.9 million. Of course, this includes the value of Accent Financial Corporation, which is captured as Puerto Rico Credit Fund of 24.9 million. And we would have increased our shareholding in Accent by about 200 and something thousand, moving the shareholding from 93.7% to 95%. And would have done that increase would have been done at the same price that would have acquired the company for. So there's a small, I guess, gain that would have been on that increased shareholding. So as we go through time, we expect, you know, Accent to come good, to enhance value for shareholders. As far as balance sheet generalized KPIs go, next slide, Ryan. Debt to total assets, you know, 0.49 times, coming from 0.47 times last year. Our current threshold limit is 0.5 times. As the business grows and expands, we may think of increasing this limit, perhaps to 0.6 times. But that's something that we'll obviously communicate to shareholders if we choose to do so in the future. Asset coverage ratio, the threshold there is to be above 1.5 times. We are at 1.78 times compared to 2.01 times last year. So we are well above the threshold limit. And in terms of, you know, debt to equity, management total target at the moment is to be just within 1.25 times, which is ridiculously low. The limit, of course, is 2 times, and you can see that we are nowhere close in terms of leverage, and this should indicate to shareholders and everyone that effectively SCI therefore has the capacity to expand and grow the business by utilizing more debt and be very nimble and flexible, irrespective of the market conditions that may arise, because we are not over leveraged, very low leverage. So the business from a balance sheet perspective is very well run. And of course, our credit rating, when I've spoken about that, carry BBB minus and JN+BBB plus with a stable outlook. Now moving into summary of activities that would have executed during the financial year. Investment in portfolio companies, 126.6 million, up 28.7%. And this excludes the value of the Puerto Rico investment on the balance sheet. If you include it, then the investment in portfolio companies is effectively 151.5 million, which is a new record for SCI. And I would have spoken about the actual total value of portfolio companies when they exclude the 24.9 million equity value for PRCF and include its actual underlying private credit portfolio in excess of 70 million. So we now have 39 portfolio company investments versus 30 last year. Of course, Accusent itself actually has 124 portfolio companies, and I was spoken about that on the opening slide. New investment commitments, 31.2 million, down from 49.2 last year. Of course, last year would have included the acquisition initial deployment to acquire the stake in Accusent. Otherwise, it would have been an increase from the 28 million that were actually deployed in underlying private credit transactions last year. So you can see that, you know, SCI doing 31 million, Accusent doing 65 million. You're talking about 2 times what we are doing. Of course, portfolio, I mean, Puerto Rico is a 100 billion USD economy, and if you take all of the Caribbean, English and Dutch-speaking Caribbean territories that SCI is invested in, it don't get to 50 billion US dollars, right? So stands to reason why the acquisition in Puerto Rico made sense and will make a lot of sense as we lever up that business in terms of leverage its growth. Fair value portfolio yield 14.8% versus 13.3%. So as interest rates go up, you know, our yields are also going up because we need to maintain that spread. Tenor 1.3 years versus 1.8 years. Of course, we have shortened the investment tenor of the new transaction being added to the balance sheet because interest rates are very high, and the objective there is obviously to benefit from higher rates. And then as we get to, you know, the period when we think that rates are about to go down, we want to then extend the maturity profile of the assets on the balance sheet to lock in those juicy yields. Dry powder on the balance sheet, 4.5 million versus 8.5 million. Of course, we are remaining talks to try and get 100 million in credit facilities. We have 2 discussions on the table that once we have additional information that we can share, and where we are with those, we will share those. But suffice to say that we are in advanced talks at the moment with 2 partners, and we are looking at additional partners. Of course, because we are in a very, you know, high interest rate environment, and we're also in an environment where there is obviously high interest rates will lead to slower rates of growth. It takes diligence to actually access international credit facilities is way more, and so it takes a lot more time. And of course, we are just 6 years old, but you know, we are adamant that we want to do this to diversify the funding mix of SCI. When we started the business, SCI basically received all its financing primarily from the Jamaican market, and we deployed all of that capital into the Jamaican market. You fast forward to where we are today, we now have, you know, an actual business on the ground in Puerto Rico that has its own funding source, and so we have financing for Puerto Rico, financing for the wider Caribbean, but primarily we are heavily dependent on the Jamaican market as a source of funds, right? And what we are trying to do now is to actually have international financing to come in to then deploy that capital. A lot of that capital will be earmarked at the Jamaican market, so we will become, I guess, a conduit for capital coming from overseas and channeling that capital into Jamaican entrepreneurs and businesses to try and help expand those businesses and help them to grow, and do the same thing for other Caribbean territories that SCI is deploying capital into, as well as into the Puerto Rican market, while the Puerto Rican market also having its own source of funding in Puerto Rico. So we're looking at having multiple channels of financing to support multiple lines of businesses and to expand and grow the suite of solutions that we provide to entrepreneurs and to businesses. So for example, well, let me not give any more examples because I don't want to give away our business strategy. But as we you know, have now effectively $200 million in private credit investment assets, we have the scale to command much larger transactions and to participate in segments of the market that we couldn't do when we just had 15.7 million. So we are looking forward to tying up some of these international financing facilities and strengthening these bonds with our international partners, and providing the local markets, both Jamaica and other Caribbean territories, with funding that is coming from international markets. And some of those funding will be structured as variable rate financing. So when rates start to move back down, effectively, we will get the knock-on effects of those benefits of having variable rate structure with a fixed asset balance sheet. Of course, we'll have to manage the risk of that in period when rates start to rise, which we can always buy hedges for that. So that's something that we'll have some discussions with everyone on once we're able to get to the stage where we have signed on the dotted line, so to speak. In terms of the quick summary on Accent Financial Corporation, I kind of went through most of this already. The company has been operating for nearly 22 decades. All right, next slide. 70 million in assets at the end of June. Of course, Accent would have had also assets that is not on its balance sheet, which are assets that were being administered. But effective July 1, these assets are no longer part of Accent's balance sheet because the company is now fully integrated and it has a clean balance sheet. All the employees have been moved out. All the non-private credit investment activities have been completely moved out. And now Accent is just structured as a private credit investment vehicle with a clean balance sheet on the asset side and a clean balance sheet on the liability side. And our job is now cut out to basically grow and expand that business to generate the benefit to shareholders that we know we can do. So in terms of new investment commitments during the year, it would have deployed 65 million as I've gone through before. Of course, in the Puerto Rico market, they are a bit more ahead of us in terms of having a dual role in terms of having true sales assets that they sell off the balance sheet, as well as assets that they keep on the balance sheet to generate net interest income. And of course, SCI is moving its overall business model to one where we have that dual earnings capacity. But we need to bring in new and different types of capital to allow us to do that at a very rapid pace. And the yield on the Accent portfolio is above 11%, and the tenor is just under 2 years. Moving on to risk management, a non-performing investment ratio, 1.4% versus 2.3% last year. Stage 3 assets, same 2 stage 3 assets. Charge-offs, there are no new charge-offs this year. There's a note, the non-performing threshold level that we managed towards is to maintain that below 5%. Of course, there's an update in terms of the charge-off from the Cayman Islands that we had last year. When effectively charge-off really occurred formally in Q1, but we would have Q1 this financial year, we would have taken the full amount of it during last financial year. So we continue to pursue all avenues on that transaction. Of course, the company is bankrupt, going through the process of see what comes out of the bankruptcy in terms of any residual claim. Again, as I said last year, my position is that we have a very low probability of recouping any monies, but let's see what comes of that transaction as we go through time. In terms of the other 2 stage 3 assets, one of them is public knowledge. So I don't want to comment on that more than say that we are pursuing all our options and we feel very strong and confident that we will recoup our monies there. Of course, our lawyers are managing that, and there's a process that is going through in terms of bankruptcy court. The third stage 3 assets is what would have accounted for the majority of the 884,000 of the ECL that we'll have taken this year as we increase the amount of charge off, well, amount of ECL provisioning, primarily because we are moving against those assets, and so to be conservative, we decided to mark down the cost drive. Just to give some insight on how we have performed historically as well as through the financial year. You know, slide 14, Ryan. So the annual ECL, which is a charge that can move back and forth based on how this is what the change in the ECL is what comes through our income statement. You would see that, I guess, the first 4 full financial years, the annual ECL would have been pretty low, and then we had the Cayman charge off, which caused the annual ECL to jump to 3.6%, and back down to within reasonable levels of 0.8% of the portfolio at the conclusion of the June 2023 financial year. And then we're also looking at how much money have we crystallized and lost as a percentage of the total capital that we have deployed. And you can see that with the crystallization of that loss for the Cayman facility, annualized at a 0.3% crystallized loss, and cumulatively to this year, this is now at 0.2%. So effectively, since we started operations, we have lost 0.2% of all the capital that we have deployed. And that's something that we are, we're going to start reporting on, but we'll continue reporting on an annual basis to basically share with shareholders how much money are we losing or not losing from a crystallized point of view out of all the capital that we have deployed. And this is an important, I guess, metric to be sharing and reporting so that investors can get a full appreciation of how we are managing risk and how the business is doing. So we're not just booking income up front and then losing it at the back end. Very important statistics to hold ourselves accountable to and for. Move to the next slide, Ryan. Exposure by industry. I won't spend any time here, really. There wasn't a lot of movement, and I know that in the MD&A we showed this to you both for SCI excluding Puerto Rico and including Puerto Rico, but for all intents and purposes, this is really what's important. I'm using the word consolidation loosely, which is the overall credit portfolio. When you look at it, how is it allocated? And you can see that 22 industries with financial services being just a tad under 20%. Of course, the construction 14.8%, manufacturing 12%. We try to stay within like a 35% industry limit, not to be overly exposed to any single industry. So if something happens in that industry, it won't hurt us. On the next slide, exposure by region. We don't have any limits here. Deliberately so, but you can see that Puerto Rico, is the largest territory at 33.4%. There wasn't a large change over the period. If you look at quarter by quarter, followed of course by Jamaica 24.8%, St. Lucia and Bahamas closely behind. And what I have to say about this, that on a go forward basis, we may see some Caribbean territories exposure increasing, some maybe substantially, as we deepen our footprint in certain individual Caribbean territories. Again, SCI is just 6 years old. A lot of what we want to do with the business, we couldn't do before because we didn't have the scale to be able to do it, right? We can't have a $50 million balance sheet and go and take on $100 million business. It just doesn't work, right? But with a $200 million private credit portfolio and diversified across, English, Dutch, and Spanish-speaking Caribbean territory, that provides us with a massive firepower to really grow and expand the private credit business across multiple Caribbean territories, which is what we are absolutely focused on doing. Now, for the final slide, which is Outlook, just providing a quick synopsis here. Percent is fully integrated into SCI, so we won't be reporting on this anymore in terms of the integration. We'll just be providing you metrics around how the business is doing, as a subsidiary of SCI, even though it's not consolidated. In terms of how we plan to grow the business, I didn't share this before, but I'm sharing it now, which is, our goal is to participate in a minimum of $1 billion in private credit transactions across the region over the next couple of years. And we need to think big and do big things effectively to really take the business to the next level. And when I say 1 billion in private credit transactions, I'm talking about, if we are party to a $100 million syndication or $50 million syndication, then that counts towards the total value of 1 billion that we're talking about, right? So we're talking about, if we launch a new financing vehicle for 100 million or 50 million, or $100 million syndication, or we collaborate with 2 commercial banks and we come in as the MES partner, or we collaborate with other MES funds or other private credit investment vehicles on a deal that is 150 million or 70 million or what have you, then that counts toward the 1 billion. And I'm saying this because it's very important for the private credit investment channel to become a major force in financing the growth and expansion of middle market businesses across the region. We are in a economic environment where interest rates are very high, and therefore, more than ever, flexible debt capital is going to be required by businesses to grow and expand, because bank financing isn't necessarily best suited for fast growing companies when they're trying to do certain things, because bank financing is it's plain vanilla, it's amortizing, and that's not necessarily the best fit for fast growing businesses that want to expand. The flexibility provided by private credit, and you can go and Google this and read this yourself. Just go and look at what's happening in the US and in Asia and Europe, what private credit funds are doing. The flexibility is really, really needed to align with entrepreneurs and businesses, and even public-private partnerships. You need, flexible debt capital to participate in transactions to allow growth and expansion, especially in an environment where rates are high. So I'm saying that to say that SCI and the SCI private credit platform, Puerto Rico, all of the other 7 jurisdictions that we deploy capital in, we are really focused on getting to this $1 billion participation level. And as we go through times, we have strategic direction to communicate. We'll communicate that to the market, but 1 billion is our goal, and hopefully we get to that 1 billion goal in under 4 or so years. So from a revenue standpoint, we need to generate more than 12.5 million. Of course, we have started that process. We are now at almost 9 billion. So we have a ways to go to get above that. Generate ROE above 10%. We're on our way to that. We're still below 10% at the moment, but of course, to get to that above 10%, we need to get that 100 million US that we've been speaking about in credit, international credit facilities, to give us that flexibility and diversification in terms of our funding sources. Of course, we are currently well, let me leave that until the next couple of points on EPS. We need to generate a 20% annual growth in the EPS. And of course, that's something that's in progress. I think this year we would have done 33% or thereabouts. But we need to really be looking at it as a target to grow earnings per share at 20% annual rate. Some years we may have dips, right? You know, things can happen in particular years, like what happened with the Cayman facility last year, which caused the EPS to dip, but then we need to recover the following year and continue and get back on the bike and ride, because that's how we enhance value for shareholders and get the business to grow and expand. Dividends yield, we're absolutely zeroed in on getting dividends to above 5%, and that's a minimum, that's not the target. If you look at private credit businesses like Ares Capital, Golar Capital, Blackstone Secure Lending Fund, all of these firms, their dividend yield, you know, is above 8% on a consistent basis, and SCI needs to get to that 8 to 9% dividend yield. So if you're going to buy the shares, that's what this stock is, and it's not because the stock price has come down, it's because the dividend has increased. And this is one of the reasons why the share buyback, which I'll get into a little bit, was launched last year in keeping with our promise. So obviously, you know, we have a number of things that we need to do to get to those levels, like the best run private credit companies on the planet. Spoke about the 100 million credit facilities already, so I won't spend any more time there. The other point I want to make, though, is that we are awaiting approval from the FSC in Jamaica to approve you know, a preference share that we want to offer, that we want to launch. It's going to be a public offer, and that will be launched in very short order, hopefully in September once we get approval. And this obviously is to continue to help grow and expand the business, but most of this capital is going to be deployed towards opportunities that have arisen and a continue that arise in the Jamaican market. And so, you know, we just want to ensure that we have a very good mix in our capital stock. We have, you know, the equity that we have pref share, and we have unsecured debt by and large, and we want to keep this very good mix going. Obviously, we want to bring in those international credit facilities as well. And one other item, we delisted the cross-listed shares, something that we spoke about, I guess, 2 quarters ago, because you know, they weren't fit for purpose. There was very low trading volume, and we were paying to the Jamaica stock, to the JC or JCSD monies for these cross-listed shares when it wasn't providing any value to shareholders. Nobody was really using them to take advantage of the arbitrage that existed between the J-dollar shares and the US dollar shares. So we felt that we needed to delist them, and we think about maybe in the future, what can we do to allow investors to benefit from arbitrage that clearly exists between J-dollar shares and US dollar shares. Maybe still, you know, get SCI listed on a different market, or add SCIs different market, a more international market, to extract that value. But that's something that we discuss, you know, way out in the future. Last thing, share buyback program, which will have started. We only did 3 trading days. It's the last 3 trading days of the financial year. 2.46 million shares. Would have primarily bought J-dollar shares because J-dollar shares were ridiculously undervalued. We bought them substantially below the book value, and so, you know, those were accretive purchases by SCI. Of course, as you know, we can only buy back shares during periods when we are not on a blackout. And so the last 3 days of the financial year, we did those buyback primarily on the Jamaican other side. I think 34 million or so is what we spent, which I think is one of the largest buybacks by a financial firm, to my recollection, on the stock market. And it was a market order. We just went and cleared the queue. But this is just our opening salvo in terms of enhancing the value to shareholders. And as we go through time, we will obviously execute additional buyback. We have 3 years, and I'm sure there will be many opportunities for us to buy the shares to enhance shareholder value. So thank you very much for listening to me rambling on. Now we can take your questions.
Yes, thank you for that presentation, Jason. We'll now jump into the Q&A session. The first question, Jason, to you is the efficiency ratio of 42.8% for the financial year ended June 2023 is now over the 40% threshold. What is being put in place to ensure that this is within the threshold next year?
Yeah, so that's good questions. As I explained, we had to pay upfront fees to initiate with our partners the search for $100 million US. And this one-time cost, I don't remember, 100 and something thousand. I remember selling, right? It's a lot of money. But you don't make money if you don't spend money, right? And there would have also been some items that we had to pay for in terms of professional fees, consultancy services that has to do with new audit standards, etc., as well as items that would have to pay for to deal with the Puerto Rico, to advise on how we value, for example, how do we value the Puerto Rico asset and bring that into your income statement. So next year, our projection is that those items won't recur. But then again, next year, if we actually lock in a part of our 100 million in facilities, then we may have additional one-off fees that we would have to pay for the actual execution of these facilities to the international supplier of the money. So, we have been very consistent and diligent in managing this ratio. I guess the key thing here is to generate more revenues, right? If we generate more revenues at a faster pace than the increase in expenses, then we won't breach the ratio. So it's a combination of the non-recurrence of one-off expense items, but also simply having a much faster pace of total investment income. And I would have explained that there were some one-time issues affecting the value of the total investment income coming from Puerto Rico. Because if you look at the March financials, you would see that we would have had $1 million US in value from Puerto Rico, which ended the financial year at 300 and something thousand. So if you included that if we didn't have those one-off tax adjustments, then we would have had the income that would have been necessary to offset the increase in those one-off items. So I wouldn't worry about that too much. And again, we set ourselves the benchmark, and we are self-reporting ourselves on the benchmark, which pretty much nobody else does. And so we hold ourselves to a high standard. And so thank you for holding us to the high standard by pushing us on that. But that's how we deal with it. We generate faster pace of revenues, and we try to contain expenses. Of course, as I said before, there are some one-off items that primarily affected it.
Okay, thank you for that, Jason. All right, our second question, Jason, is a three-part question, and it's regarding SCIPRF. All right, so the first part is, well, let me just give all three questions. The first part is, why did we increase our percentage holding in SCIPRF?
Let me take them one by one, please. Why did we increase our shareholding? Well, the opportunity came up to buy from an existing shareholder who wanted to exit. And so we took advantage of the opportunity, especially because the price at which we are buying in at is the same price that we would have done the acquisition at. And obviously we would have booked 1 million, 1.1 million last year and 372,000 this year. So therefore, we are buying at this. If we're buying at the same price that we bought at last year, then clearly there's a gain, an instant gain that is reflected on that purchase. So it's a no-brainer transaction. So that's why we did it. We bought it. That's the first question.
Yes. The second part is, are we looking to increase our holding to 100%?
The short answer is no, not in the near term. No, not in the near term. And in fact, if you think about it over the medium term, we may look to reduce our shareholding by selling shares to other investors at a premium above where we bought it, right? I mean, ultimately, because we just bought the business, we restructured, reorganized the business. We want the business to grow and expand. So we may need to we may increase our shareholding beyond 95% in the short run, but over the medium run, certainly we're gonna look to then sell down. If we buy something at $100, then we want to sell it at 120, 150, right? So ultimately, that's the strategy. At some point in the future, we're gonna want to sell down a part of our holdings to crystallize the value that we would have created in the business. That's the whole purpose of doing this, to increase the value for shareholders, right? So as we go through time, you're likely to see our shareholding increasing as we deploy capital into the business to grow and expand it, and obviously extract that increased value to shareholders. But then we want to crystallize that by selling that at a premium above where we bought it to other investors, which, that could involve listing that business, for example, 5, 6, 7, 8, whatever years down the road, or we just invite private investors to come in, or a strategic investment partner to come into that business. They buy in at a value substantially above where we are in, because that business might now have 500 million or $1 billion in assets under management, and so it makes sense for somebody to come in and be our strategic partner, spanning not just Puerto Rico but the Spanish-speaking segment of Caribbean and possibly Latin American markets. So that's how we have to think about that business. So, but we would want to have 100% per se. Not at the moment. We don't intend to do that per se at the moment. So that's the second question.
Yes. So the third part is, was there a contingency fee with regards to the purchase? And if so, how much of it was related to the prior owners?
Contingency fee. So, I mean, there was an earnout, 2 earnout periods. And in the first period, there was 2 million paid for the first owner because they hit the target, and there was none paid in the second period. So that's how I would answer that question. There are some adjustments made in terms of the actual audited financial statements. I think last year you had 92,580, and this year, and they have a reversal of that this year of 80,558. But those are really just some balancing items based on what the actual final transaction costs were. But the main thing was really the earnout, which I just explained.
Yes, thank you for that, Jason. Our next question relates to the dry powder. Most of our multi-tranche offering for the upcoming pref share, will it be denominated in USD or GMD, and is it still within the $15 to $25 million range?
So good question. So it will primarily be USD. There's a small chunk that is Jamaican dollars, but it will primarily be USD because that's where the liquidity really is from investors, right? And so it will primarily be USD. And in terms of what the range will be, that's a very good estimate. Yes, very good estimate to that range, yes.
Yeah. Next question. Will the share buyback only happen close to quarter ends? And and will it is it expected to remain or at the same level or increase, considering that we're in a high interest rate environment and the JC market is currently depressed?
So very interesting question, right? So the first part, will it only happen at quarter end? Obviously, I'm not gonna tell you when it's gonna happen, right? Because I would be setting up myself. The share buyback will happen whenever we feel that's the right time to do it. So for example, when there's a lot of supply for us to buy, because we don't want to buy, you know, we're not interested in buying a very small amounts. So well, let me put it this way. We are interested in buying amounts that fit the profile of what we are trying to do. We will do this whenever the opportunity arises, whether it's close to the end of the quarter, the start of the quarter, middle of a quarter, whatever. It doesn't matter to us. You know, we'll just pull the trigger when we feel the opportunity is right to do so. One. And two, in terms of amounts that we want to, and in terms of the strategy behind it, we have, it's a 3-year program. We have up to 9 million. You know, if I wake up one morning and the stock is doing something that we feel that is an incredible mind-boggling opportunity, then obviously, you know, we will pull the trigger, because I guarantee you that the shareholders who remain will benefit substantially from us deliberately executing the buyback at market the way that we have structured it. You know, at the end of the day, this is all about enhancing the value for our shareholders. So if we are buying back shares and the value is very, very, very accretive, meaning when you look at, you know, EPS and dividends per share and all of those numbers, it is helping the shareholders who remain, then clearly, you know, that's what we want to do. So that's the purpose of the buyback, and that's what we want to do. We said that we wanted to, obviously, it will also provide liquidity for investors who want to exit. But you know, we're not doing the buyback because we want people to use the buyback as a means to flip. For example, that's not the purpose of it, and we would be derelict and reckless if that's what we did. So the buyback will occur, and once it's executed, we will communicate that we have done it. And obviously, you know, yeah, that's all I say. I don't want to say any more than that. I hope I have evaded the question, and if I've evaded it, just ask it a different way if you want to know something else.
Okay, thank you for that detailed response, Jason. The next question regarding liquidity in the overall market in Jamaica. Do you think that Jamaica is currently going through, Jamaica currently has a liquidity problem? And if so, how do we plan to navigate this? And how long do you project it to last?
So good observation. I mean, do I think Jamaica has a liquidity problem? No, there's no liquidity issue in Jamaica. If you look at and you can take this from, you know, from multiple angles, right? If you look at the amount of deposits in banks, if you look at the amount of reserves in banks, if you look at the amount of reserves from a USD perspective in terms of net international reserves, it's just that we are in a high interest rate environment. And what happens in a high interest rate environment? It doesn't make sense for you to go and buy equities if you can get risk-free rate of double digits or low single digits for USD. Sorry, I mean high single digits for USD and double digits for Jamaican dollars. Doesn't make sense. So it's not that there's any liquidity challenge. It's just that by design, if central banks hike interest rates, absolutely what that's gonna do is gonna take liquidity from activities that people think can't beat the hurdle rate of parking the money in a risk-free asset. And that's the reason why historically Jamaica has had a problem where we couldn't grow. Economy couldn't grow because interest rates were way too high. we know this. So if interest rates move up, the direct result of that is that growth is gonna absolutely tank. So the question is, and this is not just Jamaica, it's all over the Caribbean and in the US and international markets. Rates go up, growth come down. Obviously, the growth coming down from a central bank perspective is a side effect of hiking rates, because by design they're trying to control inflation. So the question is, there's a thin line between, okay, do I get inflation under control and ensure that growth slows down to control inflation, but you don't enter into recession? So that's basically what's going on. Nothing that's happening is surprising. From central banks start to hike rates, then stocks become less attractive to investors because you can take your money and go and basically earn a decent return on it without taking on the risk of the volatility of stocks. That's just natural. Now, in terms of how we at SYGNUS address this issue, obviously we're not looking for liquidity from an equity perspective, right? We are issuing pref share, which is quasi equity. But for all intents and purposes, Jamaican investors view that as, you know, just an income-bearing asset, and that's the reason why we have the pref share that we are seeking approval to launch. How we addressing that as well? Obviously, we also issue medium-term notes, because that's what investors want. They want notes that is paying them 7.5%, 8.5%, whatever. That's for 2-3 years or whatever, right? That's what they want. And if you come with notes like and offer people to, you know, in those type of notes, those tenants, they buy it all day, every day, because that's what they want. But we are also, obviously, as I would have stated before, we started discussing over a year now, you know, getting 100 million US from international credit facilities. And by design, we did this. We couldn't have done this 2-3 years ago, simply because our portfolio was too small. I mean, we can't go to international you know, partners and say, hey, I want 50 million US. And when they ask, okay, what's the size of your investment portfolio? We're telling them that is 60 million and 70 million. It's too small, right? These guys trade in 50 and 100 million dollar ticket size for it to make sense for them. So now that we did the acquisition, we have the scale, we started the process. It's a long and arduous process, long discussion, but you know, at least we have gotten to a stage where we feel very concrete that we'll get more than one facility in place. And the thing about this is, once you know you break the glass ceiling and get the first facility in, then you will be able to get 7, 8, 9, 10 after that, because basically the first one that you do it with, you now know what the process is, and not that other financiers will use the template of the first one that you break through, but based on the reputation of the people that we are speaking with, once we are able to access those facilities, it will open all type of doors all over the world for SCI. Of that, we are pretty confident. So the task before us is to drive through the process and get it done, right? I remember when we were doing our credit rating, it was a long and arduous process to get a company that was just 3 years old at the time rated, but we got it done. And now, every year you can expect to see what SCI's credit rating is. And obviously, as we go through time, we may add additional rating agencies as the portfolio morphs into more than likely a large and larger segment being from possibly Puerto Rico and other jurisdictions that are much bigger than the English and the speaking Caribbean. So I say that to say we are attacking this on multiple fronts, but the key thing is that we operate a business model that generates spread income, right? So, okay, financing costs are going up. Hey, on the asset side, that goes up as well. Obviously, we have to be careful because some companies obviously can't afford rates above a certain level. But that's the reason why that's the reason why private credit businesses exist, and that's the reason why we have shortened our investment horizon as well. So everything that we are doing is very deliberate, because we don't want to enter into 5-year transactions at high double-digit rates. Chances are you might not get back your money, right? But we have, if our average tenor is 1.3 years, then there's a very short horizon for things to go very bad. So we are attacking this from multiple fronts, but we are no different from private credit companies all over the world. And as we have stated a number of times, especially during COVID, private credit firms thrive during periods of stress, and high interest rate environment. Clearly, you could look at it as a period of potential stress, although it is self-inflicted stress, right? It is not coming about because there is like a credit issue in the world. It's coming about because central banks have to cool inflation, and the appropriate medicine to cool inflation is hiking interest rates. So the delicate balance is how far and how fast do we hike interest rates, and the impact of that on the underlying economic activities, because then you could have a different problem on hand, which is you have a very weak economy, and then you're trying to cut interest rates to stimulate growth, and then it takes a very long time to do that. So, that's the reason why I pointed to our strength of our balance sheet, the fact that we don't have a lot of leverage, which means that we can actually take on a lot more borrowing as the needs required, without stressing our balance sheet, and just ensuring that we are managing the risk on the asset side diligently.
All right. Thank you for a detailed response, Jason. In the interest of time, we'll take 3 more questions. The first one, Jason, is actually a 2-part question. The first part is, can you say what is SCI's current exposure to Mystic Mountain, and how will these funds be recovered?
So the current exposure is about, I think, 1 million. And how it will be recovered, obviously we have a claim against the asset itself, and we also have external collateral in the form of land. And that's all I say on it. Again, this is something that is in bankruptcy court, and I don't want to prejudice our position. So I won't say any more on it other than that. I think a lot of information has been reported in the newspaper, so that should be complementary. But as I said before, we have a claim in, as the largest, one of the largest creditors, and our based from our position, we think that we should be able to recover either from that alone, and if we can't recover all from there, we have additional collateral in the form of land.
Okay.
So the combination of those two things.
Okay, understood. So the second part is, do you have any update on MV Cayman and any information you could possibly give on the other non-performing investments currently on the books?
So I think I already gave those updates earlier. So let me repeat them. So MV Cayman, it's still in bankruptcy, obviously, and we are pursuing our channels to try and recoup anything that may come from that. But my personal expectation is that that's a very low probability event. But nothing has happened with the asset. The asset is still there, going through the process of bankruptcy, which is trying to find a buyer, etc. And the third one, which is the mining asset, I would have said that we are moving against the collateral that we have on the asset, and so we took an additional charge, which would have been responsible for the majority of the ECL that would have shown in the financial statements. And so I provided this update earlier during the call. So clearly the person missed it. So that's the update that I have. If there's anything that I've said that you want additional clarity on, give them the chance to ask additional clarification. So that's Mystic Mountain, the other State 3 asset, which will remain nameless, and the Cayman facility.
Yes. All right. So the second question is in regards to fee incomes or income. So the fee income specifically jumped to 379,000 for the financial year ended June 2023. What's your expectation in terms of growing this line item or additional sources of revenue for SCI?
So as I stated earlier, when I was going through that slide, our expectation over the medium term is really to get fee income above $1 million US, preferably within the 1 to 2 million range. Obviously, I think the person is asking me about the current financial year. It really depends on a number of things, right? It depends on the timing of the financing that we are seeking. But ultimately, if ultimately fee income is driven by a number of activities, which I would have spoken to in previous earnings call, which revolve one around the volume of transactions that we put on the book and the structure of those transactions, and then items like syndicating transactions down. Obviously, I can't syndicate down assets if I don't have enough dry powder to originate the transaction in the first place. So all else being equal, we raise our financing from the pref share, and we also raise our international credit facilities over say the next 6 months or so, along with other debt transactions that we may do. We should grow this line item by a minimum of 20% on an annualized basis. But our real target is to get this to the 1 to 2 million range. So if you see us announce that we have, gotten the first financing international credit facility in place, immediately, that should be a trigger for you to say, fee income is gonna grow, because the way in which we're gonna utilize that money, or the way how that money is gonna get channeled into SCI proper, is gonna generate fee income for us. And if you see us announce that there's a second international credit facility, same thing is gonna happen. And if you see us announcing that, hey, we have just closed X in press share or what have you, then that fee income is absolutely gonna jump, because effectively one of the main drivers of fee income is to syndicate transactions, have the ability to underwrite transaction and syndicate it down. That gives you upfront income, which is very sexy and juicy relative to holding the asset on your balance sheet and waiting a year to get the same, possibly the same amount of money. So in effect, once you see us announcing that we have raised new capital, just know that fee income is going to jump.
Yes. All right. So the final question that we'll take for this earnings call is related to the Puerto Rico Credit Fund. All right. So Jason, we mentioned that we'll be closing parts of the Puerto Rico Credit Fund, especially with regards to Mexico and Panama. When do we expect these two specifically to be closed out? And we also mentioned.
Okay, let me deal with the first question.
Okay. So
it's not that we're closing parts of the Puerto Rico Credit Fund. These are just assets from those jurisdictions. They are legacy assets. They are ring fenced. In terms of when we expect to, that depends, right? They are ring fenced. They are going through, I guess, the closing out process. We don't know when that may be. Some of these may be have to be determined by a court, so I don't have an answer on that. But it's suffice to say that these assets are that we are not actively deploying capital into those jurisdictions.
Okay. All right. So the final part is regards to the investment in the special focus fund. Is this a way that you're looking to secure new funding? And this is speaking specifically to Puerto Rico.
So a very smart, that's a very smart question. So technically, absolutely yes. That's obviously, if you have a fund, you obviously need to raise. It's a capital raising exercise all day, every day, right? So to raise financing for the Puerto Rico business, it's a new financing vehicle, yes, and it's a yes, obviously.
Okay, thank you for that. Thank you for that, Jason. All right. Just to advise, any additional questions that you would like to submit, you can submit to info@sygnusgroup.com. This is the end of our earnings call. So that would round up all our questions for today. So thank you for your time, Jason, and thank you for all your time for all participants. Just a reminder that the presentation will be available on the SYGNUS Group website, and the recording will be available on the website as well as on our YouTube page. And we encourage everyone to listen to the recording of this earnings call, along with the detailed MD&A and the published audited financial statements on SYGNUS Group's website, as well as the JSC website. So thanks again, everyone, for your time. Goodbye.